Hey everybody, it's Mitt. Now, today we have to talk about a really interesting topic, and the reason it's really interesting is because it revolves around NFTs, and I am fascinated by the concept of how NFTs are constructed and what it ultimately means for NFT companies that are getting very, very big to go public because of the inherent contradiction and tension that exists within the concept of an NFT and the structure of an actual legal company. So, a couple things we're going to talk about today. Number one, we're going to quickly talk about what is an NFT for people who don't know, and number two, we're going to talk about what OpenSea, which is the world's largest NFT exchange platform. Think of it like Amazon for NFTs. So on Amazon, you go and you buy products, you can sell products. Same exact thing you do on OpenSea. And its attempt or comments of saying that it wanted to go public, and then what the backlash it got from the community, why that backlash happened, and what this means for the future of NFT stock companies, but more importantly, companies that are in the Web3 decentralized space, traditionally interacting with Web 2 or centralized finance operations, like ultimately going public. So let's talk about Chief Financial Officer Brian Roberts, who said it would be foolish not to think about going public, and with an interview he did with Bloomberg this week. Brian Roberts is the CFO of OpenSea. Now, OpenSea, again, allows you to trade and sell NFTs. The reason Brian Roberts, two first names as a name, I always find it interesting when people have two first names as a name. Well, Roberts isn't a real first name, but I guess you could say it's kind of like a first name. The reason he wanted to go public, or the reason he thought that it would be a good idea to ultimately go public, is because OpenSea is doing about $2.3 billion of gross transactions on their platform per month. I mean, it is an absolute machine when it comes to trading and selling NFTs. The reason for this is because there is an obvious market interest in the concept of owning and sharing digital goods. Now, quickly, what is an NFT? Non-fungible token. A non-fungible token simply states that you have ownership over a digital asset that you have created, and you have verified that digital asset through a blockchain technology, which is the basis for all of cryptocurrency, and you are able to now sell that digital piece of ownership on a platform that connects via blockchain, that connects to all the mechanisms that are necessary to make that transaction happen. And you can sell it like if you were selling, water bottles on Amazon. It's very simple. So the reason why NFTs matter is because for the art community, for the creatives of the world, creating digital art has never been easier and more possible because now there is a validation mechanism that actually establishes that one person actually owns this piece of art. So if I made a picture that I thought was really cool, and I upload it to the internet, anyone could just take that picture and download it and save it to their camera. And now they have my art. The beauty of an NFT is that even though it's not a physical good, because of blockchain technology, which creates a verification mechanism via smart contracts, which again, it's fancy words for it establishes proof of ownership and proof of stake within a digital asset. Now I have the ability to say, hey, no, I made this funny looking flower. It is my creative work of art, just like you would make a funny looking flower and put it up at an art auction. And that's a physical thing that we know it's one of one. Right? We know you can't just, even if you take a picture of it, it doesn't matter. So even if you take a picture of this NFT that I've created, because it is verified through the blockchain, that means it is real. It does exist. And if you buy it, because that ownership is now transferred to you, you can now sell it to someone, which means the value of the asset can actually appreciate. The scarcity mechanism never existed for digital art, and now it does via NFTs. So if you're not fully sure of like what the whole raise or buzz is around it, the one key takeaway you need to understand is that because artists and digital creators have never had the ability to verify their assets online, and now they do via non-fungible tokens, fungible meaning non-fungible meaning it can't be replicated, that creates a whole new level of supply and demand. And we know what happens in markets when supply and demand happens. There's a lot of buyers, a lot of sellers, a lot of money to be made. In the middle of those buyers and sellers, in the middle of those transactions are platforms. And platforms emerge because they can take advantage of the trends that are occurring. And if they can build seamless integrations and easy systems, i.e. PayPal, I want to buy something, just press this button. It takes a very small cut, and then the process gets easier. Then we have a very efficient and effective mechanism of being able to generate value, because now it streamlines the entire process. Think about all the things in your life that are streamlined because of small things you pay for, even something as simple as the Easy Pass. So I'm in New Jersey. I don't know if the rest of the world has this, but I'm pretty sure they do. But you pay for this little thing, you put it at the top of your car, and now you drive through tolls, and you never have to worry about standing or sitting in a line for a toll and giving $1 to the toll person. It's like you just go right through. So these are things that make our life more efficient and more easier at the end of the day. So this statement caused an uproar among OpenSea's crypto native NFT community, many of whom, I'm reading from this article, see a public listing of the platform as a sellout to large institutional investors. The vast majority of users on OpenSea are not rich people. They execute transactions between $10,000 at a time. And so some people on Twitter said it sucks to hear OpenSea is selling out and doing an IPO rather than engaging with the community, but ultimately working with banks like JP Morgan, Goldman Sachs. I mean, those would be the people who would be initiating this type of transaction. Now, why does this matter? NFTs and blockchain technology and these types of products are intrinsically decentralized. Decentralized simply means that they don't exist on a centralized sort of way of being distributed. I know I just repeated myself that time, but that's kind of what it is. Like Amazon is a centralized place where products are distributed and products are sold. NFTs are not that, right? NFTs are decentralized because you don't need a central authority to prove you have the NFT. Even if OpenSea didn't exist, your NFT can still exist on the blockchain and no one can ultimately control it. OpenSea is just a platform to make it easier. Amazon as a platform determines everything, right? If you can buy, you can sell, this, that. Like there's a trillion things they decide, whereas OpenSea is just more of an easier way to ultimately get your stuff out there and get it sold, but you have your own wallet. It's connected to yourself in the context of cryptocurrency, which means if that's the case, these types of startups, particularly Web3 startups, are intrinsically relying on their community because their community is the fabric for the startup having any value. NFTs don't have any value. OpenSea doesn't have any value if people aren't using it, trading on it, and accepting other sub-communities within that larger macro level community that exists on OpenSea. Now, communities are the basis by which many of these Web3 startups are starting. And I personally don't understand it at the level at which some other people may be super bullish on it for a couple of reasons that I'll get into. But people are trying to go away from the traditional corporate LLC structure or an S Corp structure or C Corp structure and rather go to community governance. And community governance is ultimately understood through something called a DAO, which is a decentralized autonomous organization. And DAOs are these ideas of like, okay, these people come together, they usually join a Discord because that's where a lot of this buzz is happening, and they vote, and it's sort of a democratic process on figuring out how the platform or the network that they're all a part of goes forward, how we get to the next step. And those DAOs work together with each other and they try to get something to ultimately happen. And when those DAOs work together, it creates a relationship between the platform and the owners of the platform and the people within the DAO. And I shouldn't even say owners of the platform because everyone theoretically owns a part of that platform on how to best govern what the platform is going to do. Now, OpenSea has its own founders, but because it's a crypto Web3 native startup, it reacts with the community, right? The community is involved in all of the projects that OpenSea does. It consults with the community. It works with the community. Community is becoming a very big buzzword in startups these days, but ultimately community is the foundation for a lot of how these startups are gaining a lot of value. Another app you could think about is Clubhouse. Clubhouse is an audio social network, and it is nothing without the community and it explicitly says that we are only here because our community ultimately allows us to get the value that we get. And that's not like a regular company saying like, oh, we care about our community. This is like, no, the community, if they don't exist, you don't have a product. And that's a little bit different than some of the other companies that say they care about the community. Another person on Twitter said, no surprise that OpenSea is doing an IPO instead of community governance. Anyone who's had the displeasure of speaking with OpenSea community support would know that OpenSea does not care about the community at all. They're not Web3, they're traditional finance 2.0. Brian Roberts then probably got a call from the CEO of OpenSea and said, hey, buddy, you got to go clarify some statements because we need to keep making money. And he said, let me set the record straight. There's a big gap between thinking about what an IPO might eventually look like and actively planning one. That did not sound like it would be stupid to not think of going public. Absolutely not. He then said, we are not planning an IPO, and if we ever did, we would look to involve the community. This is very, very interesting. Okay, so a couple more stats, then we'll talk a little bit more about his comments. The NFT marketplace is hot property, recording $2 billion in trading volume from 1.1 million transactions and nearly 250,000 users over the past 30 days. The platform takes 2.5% from every trade, meaning it earned over $50 million in revenue from that time period. This is absolutely insane, right? So they're doing big money. You get $50 million in revenue. You should probably think about like, hey, we should go public because these are amazing. No, companies never hit 50, it's very hard to hit 50 million in revenue. It's obviously a meaningful company. It's obviously huge demand as demand for creative art gets further and further into the future. Why wouldn't we go public? Now, this is where the ultimate tension relies. And this is what I wanted to talk about to end this off. It's like, if you are a startup that is oriented through your community and your community says, hey, we are the basis for why you are here, how do you go public? how do you become a billionaire as the CEO on the backs of that? So Clubhouse, for example, those founders, it's an audio social network, and basically there's like live chat rooms of audio. Think of it like, I don't know, think of it like, on Spotify you scroll and you see podcasts. On Clubhouse you would scroll and you see live audio rooms and people are talking. There are founders, the founders of that product have explicitly said that we care about the community. What would it mean for that product to go public and for those founders to be worth billions of dollars, and for the people of that community, the people who are actually using and engaging with the app, that the founders have said they love and respect so much, to not even get a cent of that money? Like, that blows my mind. And I am not trying to be ideological here. I actually think because the founders made that product, they deserve to be billionaires. Like, that's why this whole thing to me is kind of weird. It's like, you're not really doing much to build a company outside of participating in it. Like, yes, you are part of the community and you're contributing, but building a company is a very difficult thing. Like, I have a startup. I know what it feels like to actually build a company, and I know how much work I put in. And at the end of the day, I would want to get rewarded for some of that, right? Now, you are helping contribute to build the company, but if you're a user of like my startup, or any startup, but you're not building it with me, right? There's a fundamentally different thing here. There's a lot of different things. There's people who, contribute to Facebook, but they're not really building Facebook, even though they're contributing to it. So I think there's really important things to understand. The other thing is, like, when a company gets super big and you were there in the first 10,000 people, like, let's say you were there on a startup when they had 10,000 people and you were granted some level of equity in that startup. And when I mean equity, I mean tokens. And we'll talk about that in a second, in the startup, and you got governance rights. When that startup gets to 100,000, a million users, do you want all million people to be involved in the process of democratically voting on what's going on in the startup? Like, to me, I feel like that's an extremely inefficient way for things to actually get done. And then when that startup tries to go public, do you want the money of the founders that they get from going public to be dispersed among all those million people? How would that even happen via the SEC and regulations? Like, that's just not, it's not like we need a new paradigm. I just don't think that's real, because you have to, like, when your company is public, like, you have shareholders and people need to know what's going on with the stock. And if like random people from a Discord own part of it, that needs to be disclosed. And do they own shares? Do they own tokens? How does this operate? A lot of the community governance guidelines have been, we will issue a cryptocurrency token. So you would issue an OpenSea token, just like you would issue a Google share to shareholders. And the owners of that token would ultimately share in the value upside of that token increasing in value, which to me is like, it's like shares, but instead it's like cryptocurrency oriented without all of the regulations, which is kind of weird. But that wouldn't allow you to really go public in the same traditional way unless we have crypto companies going public with tokens and not shares in the future. So if that's the case, like, if those cryptocurrencies are the basis for how a company is now distributing value amongst all of its users because they can buy parts of the tokens, then that to me also seems weird, because that means that, if you're the millionth user and you buy like one token that's worth $50, congrats, you own $50 worth of OpenSea, which means if you buy, a fractional share of Google right now, congrats, you own $100 of Google. Like, it's the same process at the end of the day. One is a little bit more efficient and easier to get into the world. The other one seems to not be as efficient and not be as productive and have a host of difficulties in terms of figuring out who's actually part of the community. And I think that means that because of community governance, because of these tokenizations, because of people in the OpenSea community not feeling that OpenSea is actually talking to the people that are building the company or the users of the company, but rather talking to Wall Street and bankers, that it becomes incredibly difficult for NFT companies to go public. It becomes incredibly difficult for NFT companies to philosophically justify going public. Why don't you issue tokens to your users? Why would you go public? Why don't you let the users have a poll where they vote on the future of the company? Why would you have a board and a management structure? Like, all these traditional things that exist in companies, if they truly are meant to be challenged, if OpenSea is truly like, we're disrupting everything, it would make logical sense to disrupt that whole paradigm, to not go public, to raise the I don't know, $100 million they were looking to raise from their users, if their users truly are the backbone of the company, by issuing a cryptocurrency OpenSea token and just issuing it out to people who choose to buy in through some decentralized Discord or whatever, right? Like, to me, it's a very hard philosophical thing to justify. How can you, as a owner of a startup in the Web3 decentralized world, go public and become a billionaire on the backs of that community and philosophically say that, we deserve to make this money, when your entire premise for how you made that money was off the community being involved in all of the key decision-making processes? It's very, very difficult for me to ultimately understand. But I guess we're going to see what happens. In general, for NFT stocks, I don't know if I would be comfortable buying an NFT stock company because of concerns like this. And I also would want to see ultimately how management justifies this. Like, at the end of the day, they have to say screw you to their users. I mean, they just do. If you're going to go consult with Wall Street and get in bed with them, and you're going to go do it that way, you are not doing it the new way. You are doing it the traditional way. You use the new way as a commodity to ultimately delegitimize or to legitimize what you're trying to do. But users aren't stupid. They know you use them to get to the traditional way, even though you claim to be the beacon of hope to disrupt traditional finance. So if that happens, then it would be very interesting to see ultimately what OpenSea does. Let me know your guys' thoughts. Let me know you guys are bullish on NFTs. I am bullish on the concept of an NFT and digital ownership. I am less bullish on this concept of the community owns the entire product, because I think there's a lot of different things that have to happen to build a product that random people aren't really involved in, even if they're contributing by by using your startup in the same way. So let me know your guys' thoughts. This is Amit. This is the Daily Business Show. I look forward to seeing your comments, and I'll see you in the next one.